Before we start, welcome back to Chill Guy, where we keep the noise low and the signal high. Tonight's story is about a file that allegedly appeared, then disappeared like it never existed. People online are claiming an internal JP Morgan Chase note briefly showed up alongside a routine SEC filing. It's unverified, but the details are specific enough to make traders stop and stare. Right after this intro, do me a quick favor. Hit like, subscribe, and drop a comment that says, Chill Guy, so I know you're locked in. It helps the channel and it tells the algorithm this is worth sharing. Now, here's the hook. The rumor says the attachment lived on the SEC database for about 17 minutes. Long enough for screenshots, short enough to raise eyebrows. If it's real, it doesn't read like a casual market note. If it's fake, it's still dangerous because people trade stories, not evidence. So we'll treat this as a claim to test, not a truth to repeat. We'll cover what's alleged, why it matters, and how to stay rational. Quick context. Edgar filings often include exhibits and attachments. Sometimes they're corrected or replaced for boring, normal reasons. A missing exhibit can be a simple clerical fix. But when something gets pulled, speculation floods in. And speculation can move price when nerves are already tight. The alleged memo is dated 3 days before the screenshots. The timestamp is used to create urgency and pressure. It allegedly lists 3 silver levels for the next 7 sessions. The wording is described as targets, not scenarios. Target 1 is near $71, framed as a shakeout zone. The idea is to trigger stops and force leveraged traders out. Target 2 is near $68, framed as an accumulation band. The claim is the desk would rebuild longs quietly there. Target 3 is near $89, framed as the distribution level. The story says that's where profits get taken. Clean numbers travel fast because they feel engineered. Engineered numbers make people feel powerless. The memo is said to emphasize thin liquidity windows. Pre-market moves can travel farther because order books are lighter. That's why overnight gaps feel so violent. A quoted section points to 4 to 5 a.m. Eastern as a sweet spot. It claims small drops there trigger outsized retail selling. It also alleges headlines can be timed to land on key levels. That's a huge claim, and it needs hard proof. Still, the psychology is real, even without a memo. Stops cluster, margin calls cascade, and fear spreads quickly. The rumor frames silver as a tool for broader portfolio stability. It suggests metals volatility can stress bigger books. Think hedges, margins, and cross-asset limits. In that telling, pinning silver isn't just profit-seeking. It's about avoiding a bad signal at a bad time. Then the story widens into a timeline. 8 to 12 months left. The claim is physical tightness is catching up. Why would physical matter? Industry uses silver in power, electronics, and specialized components. Solar and electrification can be metal-hungry. Supply can't ramp instantly, and demand doesn't wait for charts. That friction is what paper versus physical debates hinge on. Some versions cite a possible 30% deficit within 18 months. Treat that number as unverified until sources back it. The alleged strategy is simple. Pressure price while accumulating quietly. Own supply before scarcity becomes obvious. That's not a new theory, but the alleged memo sounds unusually specific. Specificity is what makes it go viral. It describes a cycle. Push down, flush, absorb, then lift. And it attaches a profit figure of about 2.3 billion. Big numbers create big emotions. Big emotions create bad trades. The rumor also hints this isn't one desk alone. It describes allied positioning across multiple hubs. It even names the plumbing, bullion banks, dealers, and commodity firms. If true, that's influence over both paper and flow. But the story admits a limit. Delivery demand. If too many paper holders want metal, the structure gets tested. That's where paper meets reality. That's why it allegedly stresses making moves look normal. The goal is pressure without sparking a delivery rush. You'll also hear claims about vault capacity lasting only months. Time bomb language boosts clicks, so treat it carefully. Now breathe and zoom out. Silver moves on rates, the dollar, risk sentiment, and positioning every day. Even one inflation print can whip it. Large players can affect short-term moves, especially in thin sessions. But influence isn't the same as total control. So the real task is evaluation, not panic. Don't trade a screenshot like it's a signed confession. Separate narrative from evidence. Screenshots are signals to investigate, not permission to go all in. Always ask, who benefits if you believe it? If something truly hit Edgar, it leaves traces, IDs, caches, mirrors, and metadata. Real files have footprints. If those footprints don't line up, that's information too. It suggests the story may be manufactured. And yes, metals markets have had real enforcement cases before. That history makes new rumors feel instantly believable. But past misconduct doesn't prove this memo exists. It only proves you should demand receipts. Keep your sizing sane while we go deeper. Calm beats clever when volatility spikes. Your account is the only thing you control. Because the market punishes overconfidence on both sides. Survival first opportunity second. All right, now let's break down how you verify and what data matters. This is where the edge lives. Block 2. Verification is the whole game here. If you can't verify it, you can't responsibly trade it. Number 1, track the source chain. Find the exact filing, exhibit list, and any independent archive copies. Number 2, check the file itself. Compare metadata, internal references, and formatting consistency across versions. Number 3, look for independent confirmation. Multiple unrelated researchers should corroborate, not one loud account. Modern fakes are cheap and fast. A polished PDF can be generated in minutes. Start with Edgar basics. Accession numbers and file paths. If you can't locate them, you're in rumor territory. If a PDF exists, hash it and compare bytes across mirrors. Authentic files usually match across captures. Then cross-check against market behavior. Look at volume, time of day moves, and options positioning. One weird candle proves nothing. Silver's price is driven largely by futures and OTC flow. Physical matters, but paper often moves first. COMEX often sets the print, while London clears size. That's why the rumor focuses on delivery. Only a small fraction stands for metal until sentiment flips. If delivery demand spikes, incentives change fast. Either metal shows up or price adjusts to ration demand. Watch the boring indicators, warehouse stocks, delivery notices, and spreads. Boring data beats exciting threads. If spreads invert, pay attention. Also watch CFTC positioning data like the commitment of traders. It won't name names, but it shows crowding. ETF flows and lending rates add context. They can tighten or loosen paper pressure without drama. A key pattern: violent moves often hit crowded trades. When everyone leans long with leverage, dips get mechanical. That's flow, not fate. That's why the $71 shakeout idea feels plausible. Stops are liquidity, and algorithms seek liquidity, but the same footprint can come from hedging or rebalancing. Don't assign intent without proof. The rumor's two-step, flush, then accumulate, happens everywhere. Big money likes good prices, like everyone. Now the media angle, headlines amplify moves, but newsrooms aren't perfectly synchronized. A simpler reality: traders know calendars and liquidity windows. They can time risk without secret coordination. Still, metals invite these stories because they touch trust. Gold and silver feel like money, so people get tribal. About the 8 to 12 month countdown, it creates urgency. It also rhymes with real supply constraints and slow mine response. Narratives sell, data decides. New production takes years, not weeks. Recycling rises with price, but it's not a switch. Demand growth from electrification and solar can tighten the balance. But shortage has many stages before crisis. If you hear 30% deficit, ask for sources. Treat anonymous numbers as placeholders, not facts. Now the protocol language. Vague code words can be a red flag in supposed internal notes, but standard playbooks do exist in real firms. Risk triggers and escalation steps are normal operations. The rumor also says big players are no longer aligned. That's believable because incentives always diverge. When alignment breaks, volatility rises. Crowded positions unwind fast and ugly. So what should you do with this? Protect downside first, because rumor volatility cuts both ways. Avoid oversized leverage and revenge trades. Don't chase candles because a screenshot told you to. Build a checklist and follow it. Decide what evidence would change your mind before you risk capital. You can monitor those alleged levels, $71, $68, then $89. If price approaches them, watch structure, not emotion. Options, data can reveal pressure points. Implied volatility and open interest often flag where hedges sit. Skew can hint at fear pricing. Pay attention to spreads. Contango, backwardation, roll costs. Curve stress can show what spot hides. Exchange notices and rule changes matter too. Sometimes the why is mechanics, not mystery. If you care about physical, track premiums and availability separately. Futures prints and real-world supply can diverge. Premiums are a real-time stress gauge. Here's the trap. Forbidden knowledge feels powerful. That feeling is what makes people abandon discipline. Chill guy rule: if it's not verifiable, treat it as entertainment. The market pays you for being right, not early. But keep the broader lesson. Markets are shaped by liquidity, incentives, and information advantage. That's why risk management is boring on purpose. Your edge is layered thinking, macro, positioning, structure, behavior. Stack those and you'll read moves better. Now I want your take. Could a document like this exist? Or is it engineered hype for clicks? Drop your thoughts below and keep it civil. I read the comments because that's where the best signal appears. If you want more calm breakdowns when things get loud, hit like, subscribe, and comment. Chill Guy. This is education, not advice, so do your own research and manage risk.